Okay, today the topic is one of my favorites, the game Cash Flow and Assets, because this game leads to financial independence, which is a place I think most people would like to reach. So let's just make sure we're recording, and you can see the PowerPoint. Yes, it is all working. So the game of Cash Flow and Assets. Many of you probably have heard this from Robert Kiyosaki, the author of Rich Dad Poor Dad, and he is the person that has come up with this model. And first, some websites to go to. The blog is myhappyassets.info. myhappyassets.com is the website, and the book Building a Small Business that Warren Buffett would love is coming out this spring, so you can buy that at all major retailers, including Amazon.com. So just kind of a rundown of what I'm going to cover today. The picture of cash flow and assets, what that means. It's not necessarily just means a cash flow statement, which is an important financial statement, but kind of the context of cash flow. The different class behaviors as it relates to money and assets. And I always like to say this doesn't mean the rich getting richer. It means how can I, as an individual, make sure that I can reach financial independence. Oops, sorry about that. My PowerPoint skills are probably a little rusty. We'll go into the assets that you can purchase to do this, and again, it's a game where I think in a lot of ways each individual is playing some sort of a game, whether it's a career game, whether it's the money game. It's everything really in a lot of ways comes down to we're playing a giant game of Monopoly when it comes to money and investing, and so this should refine your skills. As it relates to business, what is a passive cash flow system? I think in many ways it all ties together. I think we're on some sort of timer, are we not? Basically, business, rental investing, and stock investing are all tied together, and once we can see that pattern, that thread that runs through all three, then we've got a good understanding of investing. The 4 quadrants of earners, the 3 types of income, the game of cash flow, and then any questions you can send to me. So here's the picture. Robert Kiyosaki came up with this in his book Rich Dad Poor Dad. So this is our model, our starting framework for financial independence. It represents 2 financial statements, not to scare anybody off with accounting information, but it is important to be able to read accounting statements on one level in order to manage your cash flow and your assets. But the top one here in this picture is the income statement. Income minus expenses equals what's left over, and the balance sheet, our assets and our liabilities. And the difference between the two is the equity that we built up. So a simple example of equity would be, say, a car. If you own a car that's worth $10,000, but you owe $2,000 against it, then you have $8,000 of equity. So an asset is what you own, and a liability is what you owe, and the difference between the two is the equity. So here's financial independence in a nutshell, as described by Robert Kiyosaki. This truly is our model of what we're reaching for. So if your personal expenses are $2,000 a month, that could be car, utility expenses, taxes, the grocery bill, whatever those personal expenses add up to each month. If you're generating $2,000 worth of cash flow from passive cash flowing assets in this case, then you are financially independent. So this ellipse represents the cash flow coming in, $2,000 in this case, coming into our income column, taking care of those expenses, and then it repeats. And ideally, we continue to build assets that's greater to our expenses, and it snowballs, and that's the snowball effect of financial independence. At this point, we have the option to retire. I don't think anybody will. I think you'll continue to work, but we're trying to reach this spot and then generate even greater snowball effect of financial independence. So you can see the areas that are being focused on. Um, truly, the core is in the assets, the assets that you purchase, which leads to income. And if you can reduce your expenses, you'll have a greater cash flowing model. Liabilities are minimized in the sense that most personal liabilities, that's where you get the term bad debt. So debt on jet skis, on cars. Cars are a depreciating asset. And in the context of The Millionaire Next Door by Stephen Covey, if you see anybody driving around a BMW or Mercedes and they're not Oprah Winfrey or have the means of Oprah Winfrey, more than likely their balance sheet poor. They're broke on the balance sheet. So here's the different economic classes and how they spend according to Robert Kiyosaki. Somebody in the lower echelon, they earn an income and it goes right out the door. They don't have a chance to invest any money because the income is gone through those monthly expenses, whether it's groceries or you name it, eating out expense. It's gone. And you don't have a chance to do anything with it, whether it's even to buy liabilities or purchase assets. It's gone. Nothing. Middle class, on the other hand, we go out and buy BMWs, boats, jet skis, bigger houses, which create bigger expenses, clothes. They do a lot of financing of these assets, of these doodads, and that would be where your term bad debt comes from, and that in turn creates larger expenses. The income hits up against those and it goes right out the door through those expenses. That's finance. The rich, on the other hand, and when I say rich, I know that's got a lot of bad connotations, but think of rich as maybe achievement. But the rich, on the other hand, invest in cash flowing assets, such as the three main categories being stocks, real estate, and businesses. So and they put their time first within this category, studying these assets, investing in them, and making sure they generate cash flow in the income column, and they reach a critical mass of financial independence. Again, that means I have $2,000 worth of net cash flow coming out of these assets. And in this case, if I had $2,000 a month in expenses and I've reached that, basically that threshold, and I'm now financially independent. Ideally, of course, $2,000 a month isn't a king's ransom, so you continue that pattern and hopefully have more. And again, this gives you the option to retire or to pursue better work. So now let's get into what the assets are. Now I mentioned them already, the three main categories, but it should put money into your pocket on a short-term basis, relatively monthly or quarterly. So, rental property, you get a check in the mail monthly. A dividend-paying stock typically would pay quarterly. It's relatively passive, and the reason why, because if it requires your presence, then it's just your job, and that's fine. And there's always a catch-22 here. Well, if it sounds too good to be true, it probably is. But if you're an owner of a fourplex with property management, then it is relatively passive stuff to meet with a property manager and keep tabs on them, make sure they're doing their job in places and being run into the ground. But if it does require your presence, I know that's not, well, you're just trying to find a lazy man's way out, and that's not true. Because if you say, let's even take it out of context of a property managed rental property, if you spend the time researching a stock up front, say in the Warren Buffett way of finding a good company that's a consumer monopoly that has strong and growing earnings, that has a strong return on equity, that's able to raise its prices with inflation, that has retained earnings, that puts the money back into the company and it's growing. You've spent that time up front researching that investment. Now you make your investment, and in theory it should continue to generate that return year after year and pay out. You can take that capital gain can be turned into cash flow. The only difference in that scenario is that you're investing from a business perspective, making sure that this business, you're treating the earnings as cash flow, which in turn creates a capital gain on your stock, which you can in turn into cash flow if you cash it out. So again, that's example of stock investing as a passive investment. Relatively, you do the research up front, you make the investment. The investment in the stock is the system, because say you buy Coke, you've now invested in. You're now a part owner in the Coca-Cola business, and it's always better, in my opinion, to be an owner of a business than to work for a business. So now you've got all the minds and the brain power and the backs of the employees of Coke working for you, in a sense, to generate that earning. So it is a system, and it's not a cop-out. It's not saying let's be lazy. If anything, it just takes more brain power work up front to analyze investments. Back to a rental property, you would do a gross rent multiplier analysis, which basically means, in my mind, you buy at 8 and you sell at 20. And the gross rent multiplier ratio is simply the asking price, the selling price of the property, divided by the gross yearly rents. And anything at an 8 or lower has a potential to cash flow. And then you could do, if you find that, then you can do a further analysis on it and do a monthly cash flow projection and see if there would be a rate of return. So see, there is work. In a lot of ways, in my mind, it comes down to work smarter and not harder. And here's our specific examples I've already mentioned. Cash flowing rental property is a big one, dividend paying stocks, covered call options, a business system. I would probably add to this slide Warren Buffett stock investments, because there is a debate on whether say a mutual fund is truly a passive cash flowing investment. And one could argue that, well, yeah, it pays capital gains out or it makes capital gains. And if I cash those capital gains out each year, then I've got cash flow. But the counter argument being, well, the market goes up and down. One year, yeah, you might make a 15% return, but the next year you make a negative 10%. Well, where's your cash flow now? And the answer would have to be, well, it's in a cash reserve that I keep on the side for those down years, and I rely on that cash. So in my mind, even though, well, Robert Kiyosaki hates mutual funds, but in my mind, that there is something to still be said for stock investments in that manner as a cash flow vehicle. It just I would probably take it a step further into looking at it from the perspective of Warren Buffett style investment, which is really detailed. I try to run that thread and tie everything together in the book coming out by John Wiley and Sons in the spring, Building a Small Business That Warren Buffett Would Love. And when building a business, I think if building a small business that Warren Buffett would love is the granddaddy of business fundamentals, then I think the E-Myth Revisited would almost be the prequel. He details building a system, and this, again, we get back to this. Well, somebody's going to have to mop the floor, but most small business owners get into business, and that's all they end up doing is mopping the floor instead of working on more of the systems or the strategic direction, such as a mission statement or or defining an organization chart or working on position description. So anyway, systematizing a business is important. Basically, you treat it like you're going to build 1,000 of them. A high number of franchises succeed. It's not to say you have to buy a franchise, but you can treat your business like a franchise. And this is another thing that Robert Kiyosaki details in his book, the cash flow quadrant. He divides earners up into 4 quadrants. You have your employed, your self-employed, your business owners, and your investors. And he says, really, if you're really into playing the game of financial independence, you're going to live over here, at least in part. Even if you have to, at first, if you have to live here, which I think it's true for anybody. You're gonna live here at first while you're building these. Is my opinion on that. And so, a business owner, by his definition, is someone who owns a business that has 500 or more employees or resources. An investor would be somebody that's doing Buffett type investments, or a rental property investor would live here. And what he really starts leading towards is the people over here are the owners of investments, and that leads into tax consequences. So that's the three incomes that he starts. So the tax consequences are, if we earn a paycheck, we get chopped off right at the top. There's not much we can do about it. Up to 50% earned income is taken out. Portfolio income, such as dividend income, I think is at 15% currently. And if you own rental property, you can potentially get the passive income down to 0%. The benefits of a business as it relates to taxes is that in the traditional model, again back to being employed, is that we earn an income and then we're taxed on that income off the top, and then we spend on what's left over. Well, through a great thing called expense shifting, a business owner earns an income, spends, and then is taxed on what's left over. So when you start a small business, a lot of your personal expenses become legitimately and legally become business expenses. So your cell phone is used in the business now. You use your car, so you get a mileage deduction, home office deduction. Certain travel becomes business deductible. So that's where a big shift occurs for the business owner. And then the game of cash flow, he of course has an online game that's free at his website, richdad.com, which really I view it as somewhat of a simulation. It teaches you how to invest in a simulation first before you go out in the real world and make mistakes. But let there be. I mean, you should make mistakes. Hopefully, you don't want to. Number one, you want to do as much in a simulation or a model as possible before you do it in the real world. But if you learn from mistakes. So basically, make mistakes. Just make sure that they're not critical mistakes. Again, this is the goal of financial independence. This means you get to a point where you have enough cash flowing assets to give you the option to retire. And these are the resources: Rich Dad Poor Dad by Robert Kiyosaki, the email, the success principles for goal setting and the small business development center in town. And here's my websites at myhappyassets.com and smallbizcoffee.com. And Building a Small Business That Warren Buffett Would Love is due out in the spring by John Weilandson, available everywhere. If you have questions, just post them on to the bottom of this video. Thanks a lot and have a good day.